Hey everyone, welcome to another episode of Ad Mail. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hello everyone and welcome to another episode of Ad Mail. I'm Adam Bergman, tax attorney and founder of IRA Financial. On today's episode, 3 superb questions. One involving setting up a solo K for a charity, the other about annuities and self-directed IRA rollovers, and the third about the ROBs, using your retirement funds to invest in a business that you get a salary from. Can it be done with real estate? So buckle up, got a really good, fun episode for you. Probably 8-10 minutes of your time, and you're going to learn a lot about 3 really important topics. So without further ado, let's get started. First question is from Mark Y of Greenville, South Carolina. And Mark wants to know, I'm establishing a 501c3 charity and I will be the sole employee. Can I set up a solo 401k plan? Mark, the answer is yeah. A 501c3 is a charity. It's a corporation. It's not a business, but it's an entity that has employees. And just like the Red Cross has retirement plans, just like the police department or fire department offer pension plans for their employees, so could a 501c3. So we've set up many solo Ks for 501c3s over the years. Obviously, the advantage is you can put away a bunch of that money, up to $66,000 or $73,500 if you're over 50, in a deferred plan. Now, I assume your salary may not be super high because you are part of it tax exempt, but you can put away a little bit at least to help you and your retirement savings going forward. So yes, you can do it, Mark. Great question. If you need help, we're here. Just let us know. Second question is from YouTube. I have an annuity and want to convert it to a self-directed IRA. Is this possible? So yeah, an annuity can be rolled over to a self-directed IRA, but here is the issue. It needs to be an IRA-based annuity. There are 2 different types of annuities. And an annuity is essentially an insurance contract that basically promises you a percentage of income over a set period of years, or maybe over your lifetime, depending on how the annuity contract is designed. It's a quasi-insurance type contract. You can put in personal money, or you can use an IRA to be part of this annuity. And if it's an IRA, obviously the income it gives out would be tax exempt back to the IRA, and you pay ordinary income tax on a distribution. Where obviously if you did it with personal funds, you would pay ordinary income tax on the income that it paid out. So some people like to use an IRA to invest in annuities just so they have a fixed income stream for later on in their life. The problem is with inflation, and depending on when you bought the annuity, you may not be in a great position. So can you roll over a annuity to a self-directed IRA? The answer is yeah, but the annuity must be an IRA-based annuity. It cannot be an annuity you funded with personal non-retirement funds. So how do you know? Well, you can check on your statement. It would tell you if it's an IRA annuity or not. Otherwise, you can talk to your advisor, the person that sold you the annuity. One other thing to keep in mind is that when you do terminate an annuity prematurely, there's sometimes, or oftentimes, there is some type of penalty and cost for doing so. So you just want to be aware of that. But the main thing to be aware of is it an IRA-based annuity, meaning you use retirement funds to fund it, or is it a personal annuity where you use personal non-retirement funds to fund it? Because if it's non-retirement funds, then it cannot be rolled into an IRA. If it's an IRA-based annuity, then yes, it can be rolled into a self-directed IRA, just subject to any premature penalties or fees. Third and final question of today's podcast is from Gene T of West Palm Beach, Florida. Gene wants to know, can I use the ROB structure to buy a piece of property, 2 rentals, and have it managed by a C Corp? So yeah, technically the answer is yes, but let me get into the analysis. So what's a ROBS? ROBS is known as a rollover business startup solution, takes advantage of an exception of the tax code under 4975 D13 that allows a corporation to adopt a 401k. So it allows a 401k adopted by a C Corp, not an LLC or an S Corp, but a C Corp, and allows that 401k to buy the C Corp stock, which is known as qualifying employer securities. Now, this exception in the code to the prohibited transaction rules outlined in 4975C, all the exceptions are in 4975D as in David. And this is one of the exceptions. So if you satisfy an exception, that means the transaction is not subject to 4975C, and thus it would not be treated as a prohibited transaction under the code. So why was this exception put in the code? Probably because in the 70s, early 80s, most companies that offered 401ks were large corps. LLCs were not really used. The popularity of LLCs really exploded in the 90s. 80s where LLCs were still new, especially in the 70s. So that's probably why this exception only applies to C Corps. But really, on top of that is they wanted to give shareholders of C Corps that work there, employees that also own stock in their retirement plan, the ability to do so. Right? If you worked at GE, they wanted to incentivize you, or at least allow you to have the GE 401k plan buy some of the GE stocks so you can benefit from fruits of your labor. So really in the 90s, a bunch of lawyers said, hey, if this works for GE, why wouldn't it work for a startup, franchise, or even a real estate venture? Now, in Gene's question, the issue is you need to make sure your activity rises to the level of a trade or business. So you want to obviously treat it as a business, and you would in a C Corp. You'd want to be an employee. You want to make sure this is a business. Why? Because if it's not a business, then technically it cannot have a 401k, since only businesses can establish 401k plans. So to answer your question, Gene, yes, if the rental properties are a full-time business, you're going to be paid to do this as an employee. This is going to be your job. You're going to be compensated for it through a W-2. Then yes, you can adopt a 401k through the C Corp, and then the 401k through rollover or other funds can invest in the C Corp. You can be employed by the C Corp to buy real estate. You can be the manager. The 401k will own a percentage of the company, which will allow hopefully for a very tax efficient exit. So to answer your question, Gene, yes, so long as this real estate activity rises to the level of a trade or business, then you could certainly do so through a ROBS, which will allow you to have a tax efficient exit. Since if you sell the stock, it would go tax-free to the 401k. If you sold the assets of the C Corp, there'd be a 21% corp tax plus any state tax, and then the dividend from the C Corp to the 401k would be tax-free, since dividends from C Corps to 401k plans are tax exempt. That's it. Another ad mail in the bag. I hope you guys enjoyed today's podcast. I did. A lot of fun, great questions. Keep them coming. If you have questions that you want me to review and discuss, just send them in to info@IRA Financial. Say add mail or ask Adam. You can just leave a question on social media, obviously our amazing YouTube channel, Facebook, Twitter, Instagram, or chat us up, call us, chat us, and just let us know that you want to pose a question to be discussed on the podcast, and it will get to me, I promise. Otherwise, have an amazing rest of your day. Thanks for watching or listening, and ciao. Take care.